Hey guys, hope you are all having a fantastic day. We didn't get a lot of news today from GameStop or AMC, but I do want to talk about a very well-known individual who served as vice chairman of the FDIC and has some serious dire warnings for where the markets and economy are headed. To sum up today, AMC was shown to have a short interest of 40.25% as of December 15th, which is pretty crazy and very criminal. The whole concept of letting big institutions short companies the way they are only serves to show just how corrupt the entire system is. AMC having a short interest of 40.25% is a testament that the entire stock market is rigged in favor of a small group of powerful institutions and individuals. I don't blame them, though, as they have to do whatever they have to in order to kick the can as hard and far as possible to try to see if they can maneuver a way out of their position. Imagine holding a bag of shorts which is valued more than the entire capitalization of probably all the biggest banks in America. I too would be doing everything I can to try to get away with it. The blame here lies at the feet of Congress, the SEC, the Department of Injustice, and every politician that gets easily bribed by these banks and huge financial corporations. Now, let's dive into today's big segment, but before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. Today we are going to talk about Thomas Honig, who served as vice chairman of the Federal Deposit Insurance Corporation, or FDIC. Honig has had a very long and successful career, and I respect his opinion a lot. I became a fan when he presented a speech entitled "Too Big Has Failed," in which he criticized the general approach by which financial institutions took to deal with liquidity crises and capitalization. Having worked at one of the most powerful institutions in the world, the Federal Reserve Bank, Honig is no stranger to any affair involving monetary policies. He became a bit famous during 2010, when he was the only Fed leader who would consistently vote against the Fed printing more and more bills. Between 2008 and 2014, the Fed printed more than 3.5 trillion new bills, which is roughly triple the amount that the Fed created in its first 95 years of existence. Honig knew this was very wrong, because he understood that long-term, the ramifications of this are unsustainable. As such, whenever voting came up as to how much money should be poured into the financial system, Honig became the only person out of 12 votes that would vote no. Given that he found himself alone, since everyone else in the Fed loves creating the imbalance we are seeing, Honig resigned in 2011, his reputation a bit tainted for being the man who simply got everything wrong. He was always warning vehemently that the Fed would create problems they wouldn't be able to fix. Some of these issues were that the Fed's policies would worsen income inequality, enrich large banks over everyone else, and stoke large asset bubbles. He warned the Fed's dependence on their money printing machine would prevent them from escaping it without first destabilizing the entire financial system. As you might know by now, Honig was correct on every single one of his theories, and we now are living the consequences of everything he warned us about. The Fed has become the most vile and active offender, causing most of the problems we face now in the markets. We are paying ridiculous amounts of money for gas, food, and cars. This all came to be after the Fed has been pumping certain assets like stocks and bonds for years, and now they have created the inflation we are dealing with today. As a result of this, the Fed is trying hard to contain it and attempt to control it, and their first big step in order to do this is to start hiking up interest rates in 2022. However, Honig now has another prediction, and I think we should sit down and listen to the prophet whose record has been perfect so far. Honig makes it clear and present that there will be no painless solution to solving this issue, and that it will be very difficult setting things straight, and that the longer we wait, the worse things will be. This falls in line with my very own theories as to how everything is going to fall. For clarification purposes, when Honig says painless solutions, he is talking about large unemployment, social instability, and a potential number of years of economic uncertainty, imbalance, and volatility. Honig already saw a small preview of this back in the 1970s, which is why he was so willing to throw away his reputation so easily in 2010 during the votes, and why he did not care about being a team player with people he knows were doing plenty of wrong. In the month of May of 2020, Honig published a paper that spelled out his grim and dire verdict on this new age of easy money printing, accounting for the years between 2010 until now. In the paper, he compares two time periods of economic growth. The periods between 1992 and 2000, and then the periods between 2010 and 2018. The reason for these two time periods is because they saw a lot of stability after recessions, but Honig argues there is a small but important difference in each of these two. You see, during the 1990s, economic growth in America was experienced largely because labor productivity increased at an annual rate, median wages rose by a healthy rate of 0.7%, and GDP rose by a healthy measure at 3.8% annually. However, the economic stability we experienced in the 2010s, after the big recession brought in 2008, was markedly different. GDP rose 2.3% annually, as opposed to the 3.8% during the 90s. Median weekly earnings rose only 0.26%, as opposed to the 0.7% in the 90s. The stark difference for the stability we saw in the 2010s was brought about by a single entity in the financial sector, rather than the well-performance of multiple integral parts of the economy. This single entity holding everything together was no other than the Fed. The biggest difference between these two periods, Honig points out in his paper, was that the Fed's extraordinary experiments in money printing in the 2010s, and this is a mega-huge problem, as you are about to see. The only part of the economy that benefits under quantitative easing policies and 0% interest rates are always the markets. The stock markets more than doubled during the 2010s, and even after the stock market crashed in March of 2020, the stock markets bounced back to continue their historic growth rally. Another thing that is often forgotten about is corporate debt, which rose to about $9 trillion by the end of 2019 as a result of the Fed stalking their bad policies. And now, we are only in the beginning stages of seeing the effects that this will have for us and the rest of the world. We are seeing consumer prices so out of hand that the government doesn't even know how to approach the issue, much less control it. The government is now being heavily encouraged by the Fed to spend by purchasing billions of dollars worth of treasury bonds each month while simultaneously pumping money into the banks. Like Honig noted, this is a bid demand pull on the economy, and the Fed is facilitating it. This is only the beginning stages of something big coming down the line, so you guys better suit up and become truly zen to the economic conditions that await us. This is good for us investors that are loaded up on meme stocks, because I strongly believe after compiling months' worth of evidence, that meme stocks squeeze is the inevitable reaction to bad policies and poor regulatory oversight. Honig is an absolute idol of mine, a true prophet of things to come and literally one of the few people I actually consider expert analysts. Just wanted to share this with you, because everything he has been saying aligns with our theories, and that gives me even more confidence in my resolve. I am hoarding as much meme stocks as I possibly can because I want to get paid big time when it all comes crashing down. With all that said, let's now talk about today. The Fed submitted over $1.642 trillion in reverse repo operations today. Dark pool trades for AMC accounted for 61% of the total volume today, while dark pool trades for GameStop accounted for 57% of the total volume today. AMC had a larger amount of buy orders than its sell orders, with GameStop also having a larger amount of buy orders than sell orders. Now, let's talk about performance. AMC traded bullishly, gaining under 1% for the day. The stock traded pretty bearishly during the pre-market, consistently breaking support and trading underneath the VWAP. Upon market opening, AMC slightly bounced from 27.60 to 28.35 before dipping back down to 26.62. After dipping this low, AMC started moving up, breaking above the VWAP for a while before being dragged under it but never straying too far from it. After a couple hours of trading, AMC would have a breakout, running all the way past 28.20. After a small dip, AMC closed at 27.95, above the VWAP. As for what to expect tomorrow, AMC will find support at 27, 26.35 and 25.71. Resistance will be met at 28, 29, and 29.39. As you can see, AMC traded good but not by much. I think if we fall under 27.60 tomorrow, we will test support back at 26.85 or under. GameStop traded bullishly, gaining over 5% today. It opened to a bit of volatility that took it from 150 to 142.14. After this dip, GameStop would begin climbing up, eventually reaching 155.50. After this run, it would retrace a bit and close at 153.93, above the VWAP. As for what to expect tomorrow, GME will find support at 150, 146 and 142. Resistance will be met at 155, 158 and 163. GameStop performed really well, but I really want to see it above 160 tomorrow if we are to have a good chance at closing above it by Friday. And that is all that I have for you guys today. Thank you all for watching my video. Let me know in the comments section below, where do you see AMC and GameStop in the long-term future? If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day, keep on buying the dip and to the moon.